So I can run through these pretty quick. I know we're at 5:30. We said we'd go until 6 today. If any of you did have to get up and leave, it wouldn't be the first time someone's done that while I'm talking. No, it's sort of this next category of things I'm going to talk about. These are kind of expansions of things we've already been dealing with, so kind of net benefits. But there's a few things to consider. So I'll go through these pretty quick, and we can get back to the more interesting stuff. Like everyone has probably heard by now, the corporate tax rate is lowered to 21%. It doesn't apply to S corps or partnerships. The biggest question this is raised from our clients is it pass-through entities should incorporate to take advantage of low tax rates. And we have a whole section on that we'll go through. The only other thing I can think of that's really relevant is financial statement tax provisions are all going to have to be revised to take into account the tax benefit or liability at the lower rate. So you might see some pretty big swings in book income as a result of the tax rate change. Corporate AMT repealed for years after 2017. Biggest impact there is a lot of AMT related limits on using general business credits like the R&D credit are going to go away. Kind of a nice benefit is previously, I guess if you were an AMT for a corporation, you could only use 90% of net operating loss. So business that had accumulated losses always had to pay some amount of tax. I guess that's going away, so that's kind of another net good thing for C corporations. Bonus depreciation, again, something that's familiar to us and that we've been planning around for years, increased to 100% and made retroactive to September 27th. So we're really happy about that. There's a phase down of the deduction starting in 2023, and then after 2027, there's no more bonus depreciation. Kind of the trade-off for getting 100% bonus was losing the interest expense deduction. Hopefully the interest deduction phases back in, maybe after the expiration date of that provision it will. The other big change is now bonus depreciation can apply to used property. Previously it had to be new. The other thing, on the last bullet, real property trades or business, which could be anything from rental real estate to development to construction, have the option to elect, lose the ability to take bonus depreciation if they elect to take the interest deduction instead, which, depending on mortgages on commercial real estate, maybe some people are going to get a benefit from doing. Section 179 expense, again, basically doubled, and kind of the best thing about it, the immediate expensing election has been expanded to a lot of categories of things that previously we couldn't take it on, primarily building components. We'd always get questions about, can I capitalize or expense this heating unit, air conditioning unit? Now the answer is we can write it off. Keep in mind, though, the restrictions on 179 expenses, it's limited to active trades or business, which generally excludes like passive rental real estate. And there is also a number of restrictions on what types of shareholders can take that deduction, and a requirement that you got to be active in the business. So there's kind of a lot of planning you need to do at the entity level in order to make sure that all the owners of the business need to get this deduction. This is kind of a funny topic. For years, ever since 2001, we've had qualified improvement property and then qualified leasehold improvement property, and then they added restaurant property and retail property and other things, and have kind of tried to consolidate all of this under one heading. But then someone, I guess, fell asleep at the photocopier and they sort of forgot to include this in the final bill. But we understand that there's going to be a technical correction that comes out, and when that happens, this will be in. So again, this is maybe the only thing in there that's actually simplification, is they've combined a bunch of different categories together and made it easy to say, hey, if you meet this definition, if you're doing anything that would otherwise be capitalized over the life of the building, but it's interior non-structural improvements, you can take it over 15 years instead of 39. So net good thing. We just have to wait for the technical corrections bill, I guess. Where it is, you're going to be able to take bonus depreciation on these. There was some language in the law that said we're specifically going to exclude this category, but because of the general rule that says 20 years or less, you get bonus depreciation, kind of brings it back in. So that's another thing we're going to have to wait for the final answer on, but boy, it'd be pretty great if we could get the 100% bonus on that category too. And it looks like maybe we can. Let's see what else. Before I talk about this, some general recommendations about cost recovery. Probably a lot of people in this room have had cost segregation studies or at least know about them. You know, generally when you've got a large project going on, we recommend something like that because it's really going to help support the allocation of costs between the 39-year structural stuff and the 15-year, you know, potentially shorter life eligible for bonus, internal non-structural. Usually those studies, they pay for themselves pretty quick in terms of cost benefit. The other thing I think about is if you have maybe a small project coming along when you're talking with a contractor, show them these rules, see if you can get them to give you the quote sort of along the same lines the IRS would have you divide up the property. So maybe at that stage you want to get your CPA involved, but you get the contractor to do it. Maybe that's a great way to get that breakdown done for you so when it comes time to do your tax return, you get something prepared by a third party, you know something about building construction, can tell you how we can categorize those costs. A lot easier to get that though before you make the final payment to the contractor. Let's see what else we got. Oh, okay, sorry, excess business losses. I had mentioned that earlier, you know, that's essentially a new loss limitation that says when you've got one of these types of entities, you know, basically our pass-through entities and our Schedule Cs, Schedule Es, excess losses are basically going to be aggregated. I think that's mostly going to come into play in a year when you've got a big construction project. You get a lot of that 100% bonus depreciation, which can quickly, you know, throw you into a 6 or 7-figure loss, depending on how much money you spend. So instead of fully offsetting taxable income, any loss that's generated after 2017 is only offset 80% of your taxable income. So even businesses that have no operating loss carryover are going to have to pay some amount of tax. Again, that's kind of a similar change. They're following more of the rule that applied to alternative minimum tax for corporations where they limited your NOL. Then finally, there's a couple of things that are worth looking at for certain taxpayers and the small taxpayer exceptions. This is another thing that might be a legitimate simplification. If you've got under 25 million in gross receipts, you're going to be able to do a lot of helpful things like take advantage of extended use of the cash method of accounting. We generally like that because it provides a better mismatching of income and expenses and a lot more flexibility. So that's something you can look at. It would be a change of accounting method form that gets filed with your 2018 return, but I think for a lot of taxpayers that might be beneficial. And then the ability to no longer have to account for inventory and avoid the unicap, which is the IRS's attempt at cost accounting and adding some general and administrative expenses to inventory. You can get out of that as well. So small taxpayers will be able to take advantage of that.